Hi, everyone, and thank you so much for joining a little bit of a brighter makeshift office today. But I thought I'd just jump on and give you a quick update before tomorrow's key budget. There's two major things going on in the next week. Of course, we've got the UK budget tomorrow, and we've got the US election in just a week's time. So it's all going on. And I think what's fascinating is the markets have been really quite sanguine about this. Stock markets are higher, bond markets, however, less so. If we look at the first chart, so chart one, we'll just wait for that to come up. Brilliant. So this chart, as you can see, the orange line is pound versus US dollar, or the cable rate, and the white line is the 10-year bond yield. Now, we've seen something quite interesting. As the pound has fallen really, really sharply, we've actually seen the bond yield move higher. Now, that's not unusual over the last few years. As you can see in this chart, they don't really have much of a correlation. But usually when bond yields are moving higher, you expect the pound, you expect the currency to move higher with it, because that's its yield, which really powers currencies. However, that's not been the case. So that suggests that bond yields have been moving a little bit higher because they're a bit worried about the budget. So we've got the budget tomorrow. The government have been very clear about what to expect. So there's tax rises. What they're saying is that this is all part of the greater good, to better public services, to boost growth in the long run. They're also going to unleash new investment, although details of those investment plans will not be announced. Now, the key thing to watch tomorrow, in our view, is the OBR budget forecast. So that's the Office for Budget Responsibility. They will produce forecasts on what they think the measures in the budget will do for growth and also for the UK's debt levels down the line. Now, for the pound to recover, we think we're going to need to see stronger growth forecasts and also signs that debt levels are stabilizing. Now, they've already changed the debt rules. We've spoken about that before. I won't go into too much detail about that here, but we're definitely looking for more stable debt levels in the future. So in the next kind of 3 years. So that would be really, really key. We are also expecting, if that does happen and they do upgrade those growth forecasts, they would anyway, because growth has been better than expected. But we do expect growth probably at least 1.5%, maybe even 2 to 2.5% in the future on the back of these measures. So if that does happen, then we would expect a stronger uplift to the pound. Now, what about UK stocks? Now, some of these tax measures, they're going to hit capital gains tax. So we have seen some downside for some of the wealth managers, St. James's Place, for example. However, you've got to remember that the FTSE 100 is a really international index. So even companies like Flutter, they own Paddy Power and other betting companies, they derive most of their income from overseas. So they're unlikely to be touched. So we don't think the FTSE 100 will have a massive reaction. We expect the bulk of the reaction in the pound and in the bond market, and we will be watching that for you. Now, if we can just show you segue into another topic that's really crucial for markets at the moment, which is, of course, the US election. I want to talk a bit more about the Trump trade that you may have heard about. This is the second chart. Now, this is the average of the polls that are out there for the US election, which takes place, US presidential election, which takes place next week. As you can see, it's really narrowed. It's not only narrowed, but now Donald Trump has a slight lead over Kamala Harris with 48.6 versus her 48.4. So it really is a coin toss. It's almost too hard, too tight to even try and make a guess about who's going to win next week. However, the market seem pretty convinced that Trump is going to win. And there's something called a Trump trade that's been going on, not just in the last couple of days as these polls have narrowed, but probably over the last month. And what the Trump trade is basically is a stronger dollar, generally quite good for stocks. And we've also seen rising bond yields, because remember, Donald Trump really wants to increase the size of the deficit to give all those unfunded tax cuts to the American public. And that's pushing up bond yields, but that's also pushing up the dollar. Now, to put this into some perspective, I've got it written down here, the dollar is up against the yen 6% since the start of October, 2.2% higher versus the pound, and 2.5% higher versus the euro. So some really big gains there in the dollar. And we don't see the dollar coming off in a meaningful way until we get the outcome of this election. The other thing that's worth notable, that is really notable at the moment, is gold, up 30% year to date. Now, we think that gold will continue to do well, whoever wins the US election, and it could end up being the trade of the year. Now, on top of all of this, we've got to remember that there's a lot of of big earnings reports as well. Trillions of dollars of market cap in the US. NASDAQ, they are all reporting earnings this week, including Apple, Microsoft, and Google this evening. Now, we will be following them, so please check out xtb.com, our website, to get all of those details and everything you need to know to trade. But it is worth noting stocks are performing very well, even with this event risk on the horizon. Got a few jitters in the pound, with the pound hovering below 130. And really, if we're going to get a good budget, and one that's well received by the markets, watch the pound. We would expect the pound to rise above 130 if the market likes what it hears from Chancellor Rachel Reeves tomorrow. But we will be doing a live over the budget tomorrow as well. So, or just after the budget, sorry, tomorrow. So please do join us then. And thank you so much for joining today. Okay, thanks, guys.